morning, everyone, and welcome to the last quarterly INN8 Invest DFM Future Focus webinar of 2023. Can you believe it? We're at the end of the year. And just a reminder that Future Focus is a series of webinars focused on understanding the world of fund managers and comparing and contrasting the best investment management skills, not only in South Africa, but globally as well. And we cover the most important topics affecting investment management today. So many of you joined us at our inaugural INN8 Invest in-person summit on the 13th of September at the Forum in Sandton. The event was completely oversubscribed, packed to capacity with advisors from across the country, and we had some phenomenal panels on the day. My personal favorite being the one with Henrik de Tooy, the CEO of 91, Anton Pillay, CEO of Coronation, and Derek Msibi, we'll chat a little bit later, CEO of Stand-Up, discussing the future of asset management in South Africa and globally. We also had talent like Neville Chester of Coronation, Dwayne Cable, Murray Winkler, Cy Jacobs, Ian Power, Sands Capital, JP Morgan, etc. And given that the elections are just around the corner, we had Justice Malala unpack and discuss what we can expect from next year, from coalition combinations to policy. So that was really interesting, some fascinating insights. And if you want to catch those sessions, just check it out on our LinkedIn page, INN8 Invest, and you'll be able to catch all the sessions on the summit of the day. I think it'll be really worth your time. As you know, last year in 2022, we won the Citywire DFM Overall Performance Award, which was a fantastic award because it's a testament to 25 years of running money for clients and achieving outperformance. But I personally didn't think that we could top that one. And earlier this year, in October, at the Mount Nelson, we won South Africa's DFM of the Year. So yes, the team competed against all DFMs in South Africa, and your DFM came out #1 in the country, not only based on performance, but on the overall proposition as well. So the team is really excited by the award, and I'd personally like to thank each and every one of you for your support and continued support. And if you're looking for a DFM and want to partner with the best in South Africa, you know where to find us. For those with co-branded or customized solutions, as you know, we've just been through your personalized investment oversight committees with your dedicated portfolio manager. And today we have an action-packed session kicking off with Rico Venter, portfolio manager and joint head of portfolio management at the DFM, will give us the latest performance overview of the DFM core solutions. As a reminder, in our last session in August, we chatted and discussed the living annuity conundrum. So how to understand smart ways of building portfolios and thinking about portfolios within a living annuity context. And we had 91 and NMG as well. So you'll be pleased to hear that we'll be launching our very own living annuity solutions that combines most of those major insights that you heard at that webinar. So both science and behavioral aspects that we believe will offer clients and advisors the most unique living annuity solution in South Africa. So we're looking at before H1 next year, we'll release that. Very exciting topic today. We'll be delving into the business of asset management. So how influential CEOs of some of the most recognized asset managers in South Africa have led and will continue to lead their businesses into a very choppy future, right? I mean, we know that things are really difficult in the global environment today, and the anticipation and looking forward, one can't see that volatility and uncertainty would increase. So managing a asset management business today is a tough job, and we've got the business leaders to discuss how they do it and what sort of challenges and opportunities they see ahead. Then Rico will dig deeper into what we call the hybrid approach to portfolio construction. That's how to build robust solutions with this wider offshore opportunity set that Regulation 28 has offered us through its changes recently. So from a housekeeping perspective, if you have any questions, please feel free to pop it in the Q&A box. I'll try, and the team will try to get to it during the webinar. And if not afterwards, we will be applying for CBD points for the webinar. So please keep an eye out for the notification. You've got to stay through the whole webinar, by the way, to get that. And this will be recorded and available in the next few days. And all slides and presentations will be distributed as well. So this is going to be an action-packed session. So without further ado, I'd like to welcome Rico Venter. If you guys don't know who Rico is, Rico has his BCom Honours, Cum Laude, and CFA, and the joint head of portfolio management at INN8 Invest. He has 19 years of industry experience. Rico started his career in 2004 as a Life Healthcare, at Life Healthcare as a credit analyst. In 2005, he had the opportunity to work for the FSCA as an analyst in the Collective Investment Scheme department, where his passion for unitized investment started. He subsequently joined the Stand-Up Group in 2007 and served in multiple roles, including heading up Stand-Up Asset Management Implementation and Analytics team. In 2013, he joined our DFM as a research analyst, conducting investment research and building investment management tools for the business. Since 2016, he's become a member of the portfolio management team, managing various multi-managed funds and models. He's currently the joint head of portfolio management, as mentioned. Enrico is a CFA chart holder and BCom honors holder from the University of Pretoria. Rico, welcome. We're looking forward to hearing from you.
Excellent. Thanks, Lee, and thanks for the introduction. Lee, just confirming if you can see my slides on the screen, then I'll jump straight away. Perfect. So my session today is just a brief overview of the INN8 range in terms of performance. I'll touch on a few key factors currently driving the market. And then I'll just end off with our view on how we are currently positioned and how we see the world in conjunction with the underlying managers used in the solutions. Now, I was looking for one cartoon that really explains what's happened this year in the market, and this was the closest cartoon I could find. And this year's all been about the Fed trying to maneuver what we call a soft landing. Now, a soft landing is this combination of getting inflation under control, but not pushing the US into a recession. Now, we do think the Fed probably has maneuvered the soft landing, or they're building up towards that. There are some experts in the industry saying that the Fed will likely push the US into a recession, but if such a recession occurs, it will probably be a mild recession. Now, these decisions by the Fed and how the market reads it has been pushing markets up and down and created a lot of volatility over the last year, or even over the last 18 months. Just last night, the Fed released their minutes from their most recent meeting, and there wasn't really a lot of conversation, at least, on starting to cut interest rates. So while the Fed seems to have inflation under control, they do seem to feel that they need to keep rates a little bit or higher for a little bit longer, just to manage inflation. And subsequently, the market didn't really receive it too well last night either. This has also created a lot of inflation across the globe. In South Africa, we felt that inflation prices just escalating a lot across the world. That's been felt, and on top of that, the higher interest rates just eating into spending. We all know from bonds and payments on various loans that really chokes the economy and is typically not good for asset prices. Now, we spoke about the Fed. On the bottom left, the picture just depicts China. Property market's still quite challenging there. China hasn't come out of the blocks as after COVID as strong as people expected them to. We saw some interesting retail sales numbers coming out this week, starting to show some improvement in the consumer in China, but it's still early days. Some positive meetings between the leaders of the United States and China. So a few positive things, but we're still watching, having a close eye on China, and a little bit reluctance from a lot of the managers in the solution to be too heavy on China at this stage. And then the bottom right, a wild card for the solutions and the economy as a whole is the oil price. There was a lot of concern with tensions in the Middle East that the oil price would escalate out of control. That subsequently came back well, and that risk seems to be under control. We just saw the US as well. A lot of stockpiles building up in the US. So the global economy is really not big on demand currently on oil. And at the other end, we've got OPEC debating whether they need to cut supplies further. So we're going to see a bit more volatility probably in the oil market, and that's another one to look out for in the weeks and months to come. Turning to South Africa, sentiment towards South Africa has been weak. We all know there's a lot of bad news around the South African economy. Growth is very weak at the moment. Eskom's been a big culprit, pushing growth lower. But in the last few weeks, starting with the Rugby World Cup, we started seeing some improvement in the Eskom's energy availability factor. It's not just South Africans that picked up on this. It does seem like foreigners started picking up on this as well. And interestingly, in past surveys done, foreigners typically see energy supply as one of the key elements that has to change before they start entering back into South Africa in terms of their investments. So hopefully we're starting to see a bit of a change on that front. We've already started seeing foreigners entering our bond market again. Very nice rally from bonds over the last 6 or 7 weeks from SA government bonds. So hopefully this trend continues and we've got some improvement, especially on the sentiment side, which will help unlock value. Performance till the end of October. And I know it's only 3 weeks old, this data, but quite a lot has changed in the last 3 weeks. But nonetheless, the last 12 months until the end of October, global equities, the top performing asset class, you really wanted to have a sizable exposure to global equities, which fortunately we had across the INN8 solutions. Global bonds, not great performance. The SA bonds also 7.9% over the last 12 months, by no means any exciting returns, and SA cash steady return. But really, global equity is the place to be. Over the last 3 months till the end of October, the one that sticks out on the negative side, those are the darker blue bars on the left-hand side, SA equity, down 10.3% for the 3 months till the end of October. So that was quite worrying. Fortunately, in November, SA equities back up 6 to 7%, global equities up quite a lot, the NASDAQ up 10% in dollars. So we had a big risk on event happening in November, a lot of positive sentiment globally, and that would have changed a lot of the bars you're seeing here. If we look at performance of the solution, generally pretty pleasing given what's happened or unfolded across the world. The flexible income solution over the last 12 months, returning 8.9%. I think what's key for us, well ahead of our peer group averages. So the other multi-asset income funds in the industry on average. So they returned 8.3%, we returned 8.9%. And quite pleasingly, what we did in the solution at the beginning of October, we actually included a manager called Visio, the unconstrained income fund, high duration fund, and timing was very fortunate for us. That fund would have really boosted the performance of this model in October and going into November. Longer term, also looking very good for us versus our peers and the CPI objectives. The stable growth, this is the low equity model. We manage 7.2% return, also well ahead of the peer groups or on average, the other low equity funds in the industry at 6.8%. Moderate growth also ahead, high growth ahead. And if you look just slightly longer, very good alpha for us over those models. And then the flexible growth portfolio, this is the portfolio with the high offshore exposure, circa 60 to 65% offshore in this model. Pleasing return at 7.7%, but in the shorter term, just lagging behind the worldwide flexible category. But as soon as you just move out slightly longer term, again, well ahead of the peer group average there. Now, some of the drivers of performance, and I just summarized key performance drivers in one table. On the flexible income model, Prescient and Aluwani has done very well for us. Prescient is part of our discussion today here. Aluwani also doing very good for us on the credit side. 91 has lagged, but quality solution from 91 that really helps in the overall construct for us and provides a bit more of a defensive element to the portfolio. If we look at the regulation 28 compliant multi-asset portfolios or balanced type portfolios, stable growth, moderate growth, and high growth, the big performance driver has been the global equity exposure. And we had a sizable exposure across those portfolios, obviously dependent on the risk profile. Managers that's done well for us, they're 91, they're cautious and opportunity portfolios. And as many of you will know, 91 prefers a lot of offshore, especially offshore equity in their solutions. And within their offshore, a lot of their tech stocks doing exceptionally well for them. As a matter of interest, the Nasdaq is up 35% year to date. So most of the managers that had some elements of exposure to Nasdaq type of tech shares, whether it's NVIDIA or any of these type of shares, would have had done very well with those positions. On the right-hand side, over the last 12 months, SA bonds have detracted, but as I mentioned, fortunes have changed for SA bonds. The yield has come down all the way from 11% on the 10-year to 10% in a matter of 6 or 7 weeks. So we're going to see a lot of that performance start coming through in November. Truffle has been a manager that came under pressure. Truffle, a really good quality portfolio manager or fund for us. It's not been Truffle's best 12-month period. Stock picks like ABSA has been unfortunate for them. British American Tobacco has underperformed for them. And Truffle's generally been a bit more concerned about global equities. They've been underweight global equities, and that has been the outperforming asset class where they left some performance on the table. And then the flexible growth portfolio, the high offshore exposure portfolio, a few pretty good performers for us there: Coronation, Global Optimum, Stanlip's, our retail branding, multi-manager global equity fund, some of the best global managers in that solution, and very good long track record there. One Invest, MSCI World, and Batelier, also a very good performer for the solutions over the last year or two. Again, detractors, the main one, Truffle, and 91's Global Strategic, also coming under pressure due to various factors, including their overweight to certain Chinese stocks. Now, just to wrap up the outlook. So we've got a fairly positive outlook, and a lot of that insight also comes through from some of the excellent managers we've got in the solutions. Now, the underlying managers are mostly positive on the outlook for South African assets. There are various reasons. Cheap valuation on our equity markets. Our equity markets are trading very, very cheap. You have to be good stock pickers, we think, in this environment to really find those value stocks and avoid some of the landmines. And we think some positive sentiment towards South Africa will help unlock value in the South African equity market. So quite happy that our managers do currently take some exposure in SA equities. We think load shedding will improve in 2024, and a lot of that insights and research done by the managers confirm that view. Now, it's very difficult to put a timeline on it, but the sense is towards the end of 2024, the load shedding situation should be much, much better in South Africa. There are various reasons for that. One of the primary reasons being private installations, renewable energy projects, etc., as well as some efficiency gains on the Eskom side. That will be very, very positive for local assets. And then a very positive one, we're likely at the peak in interest rates globally. Obviously, the Fed drives this globally, or is the main federal bank most look at. As they enter their peak, it might take a little bit longer and might stay a bit longer, higher for longer, but we do think at this point in time, it's a good time to be investing in. So what have we done? We've been tilting managers to increase exposure to growth assets over the last 2 months, as well as SA bonds, and we think this positioning will really enhance performance for the range. Thanks for watching, and back over to you, Lee.
Thanks so much, Rico. I think, you know, in a very tough market, the performance has been phenomenal. So well done to the team. You know, keep on digging and keep your heads down in terms of finding those managers. I mean, we had a nice comment by Norman in the box now around the performance, and I think, you know, a good combination of really good managers combined with you know, overall asset allocation. I think the performance was very good relative to peers. And just given our overweight to risky assets generally in the portfolios, I mean, November, with the market run in November, I think we'd see even, you know, better performances coming out this month, which is great. You know, you want to be in a position to pick up that when market starts to run, and the portfolio is positioned well to do so. So thanks, Rico. We'll chat to you a little bit later. Next, we have we're going to start our introductions to the asset managers that we've invited today. We have three. We've got Fairtree, we have Prescient, and we have Standard, and the CEOs of each of those businesses. So first, I'd like to just welcome Bradley Anthony, MD of Fairtree Asset Management. Bradley has extensive financial markets experience of having started his career in banking in 1993 at Nedcor. His banking roles extend from fixed income trading and structuring to the head of domestic treasury at the Cape of Good Hope Bank. After a few years at Rand Merchant Bank, Bradley pivoted from banking to asset management. He has since held several senior positions within asset management, including head of fixed income at BOE Asset Management in 2002, chief investment officer of Momentum Alternative Investments in 2007. And Bradley joined Fairtree, a leading global investment manager, in 2011, and is currently managing director of Fairtree Asset Management, responsible for managing and directing all business operations and ensuring the integrity of all investment processes. Welcome, Brad.
Thanks, Lee. Thank you, Lee and team, for the opportunity to participate today. Appreciate it. And just again, well done on the award. Great to see you guys performing and doing so well. I want to take a couple of minutes just to give a brief intro to the business for those of you who don't know us. And then we can chat a bit later. So first of all, this first slide, just a snapshot of where we are. I think this is to the end of September, about 125 billion in assets under management. We are independently owned business with, I suppose, a fairly unique structure where there's incentivization across the business for all senior people. The business developed as a institutional type business. We started out as a hedge fund with a range of hedge fund businesses invested into our business, and so we developed and evolved the business as an institutional quality asset management business. The one unique thing about our business, I suppose, starting out as a boutique, is that we started focusing on the institutional market as a result of the genesis of the business. But over the years, we've also been blessed with the ability to attract investment from a range of very large global institutional investors. So today, our asset base is actually about roughly 40% from global investors and not South African investors. We still run our hedge fund business. We still have our alternatives business, but to a large extent, you know, the traditional long only businesses has started to dwarf that. About 100 people in the business, with a fair amount of those people being in the investment team. If we go to the next slide, just a stylized sort of introduction to the evolution of the business. As I said, genesis of the business back in 2003 as a relative value equity hedge fund, and over the years we've added capability. So if you go back to 2003, it was a couple of people in a room outsourcing most of the non-core responsibilities within the business. But over the years, we've added to the capability, and we've added to the robustness of the business platform, for lack of a better expression. That sort of culminated in the 2011-2012 period, where we managed to secure our first sovereign wealth fund client. And then slowly evolved the business from there. Today, we have exempt reporting advisor registration in the US. We have a couple of US-based investors, a couple of North American-based investors. We are FCA licensed in the UK. We obviously have FSCA license in South Africa, and we have an asset management license in Guernsey. Our ambition is to be a global diversified asset manager. We've developed our product range. We've talked to our partners and our stakeholders about how we can evolve and grow this business to meet their needs across both South African and global listed and unlisted assets. If we go to the next slide, one of the things that are important to us as a business is our culture. We believe that to a large extent, it's our culture that differentiates us both internally and externally. We've kind of articulated a purpose statement, which resulted in a bit of work that we did with a facilitator who helped us look back at trying to understand our DNA. You know, who are we? as opposed to setting an ambition. And so that purpose statement is to enrich the lives of all Fairtree stakeholders. And Fairtree stakeholders are essentially staff, shareholders, suppliers, clients, regulators. And so everything we do, every decision we make is constantly framed within our 5 core values, which you see on the right-hand side of the screen. And it has to serve this purpose of enriching the lives of our stakeholders. And we don't always get it right, so let me just say that up front, but this is what we are striving to do. This is the heart behind what we do. This is the heart and the DNA of Fairtree. We constantly refer to these values. We constantly refer to our purpose statement, and we try to act in alignment with that at all times. So how does that translate into what we do as a business? What are our product range? If you go to the next slide, you'll see our product range is basically, in our mind, split into 2. We look at the business opportunity as those opportunities that participate in public markets and those that participate in private markets. We need to change our language on this slide, but it's basically within South Africa and globally. Offshore is not a great word to use, but I suppose it's a South Africanism. But we look at public and private markets in South Africa and globally. And in public markets, these are essentially listed securities, bonds, equities, etc. We manage long only and hedge fund constructs. So we have in South Africa a range of long only unit trusts, hedge funds, etc. And globally we have the same. And in private markets, essentially we run a range of private market opportunities in real estate, infrastructure, and the like. Thanks, Lee.
Thanks, Brad, and we'll hear from you a little bit later. And by the way, Brad is calling in from London this morning, so it's 2 hours. Sort of the time difference is 2 hours, so it's really early in the morning for Brad. So Bradley, thank you so much. Next, I'd like to introduce Shri Dyer, the CEO of Prescient Asset Management. Shri was appointed as the CEO of Prescient Investment Management in 2018, has been a member of the board ever since. She joined the Prescient Group in 2005 following the completion of her articles at KPMG and having worked in London's financial services industry for 2.5 years. In an 18-year career at Prescient, she held a number of key positions, her last being one of CEO of Prescient Securities, the stockbroking arm of the Prescient Group. Shri has a broad knowledge and experience of the financial services industry and serves on the investment committee of ASISA. Outside of Prescient, she is a chairman of the Genre board of directors, as well as member of boards of PMT Limited and Sabi Sabi. She's passionate about sustainable change, developing young professionals and driving diversity in the investment industry. As a CFA Society South Africa and Prescient Foundation board member, she actively fosters change in the investment industry and society. Welcome, Shri.
Thanks very much, Lee. Thanks for having me today. And again, from my side as well, congratulations to you and the team. And also congratulations to Brad on the achievements of Fairtree. It's always good to see a fellow competitor doing so well. So thanks very much. I'll briefly take you through the Prescient story. As you can see, we position ourselves as the future of investing, but the story is not new. We've been around for the past 25 years. Just see if I can get my slide to move. Is it moving on your side, Lee? Ah, there it is. Okay.
Let's move now. Yeah.
Okay, great. Okay, so we've been around for 25 years. Oh no.
We've just lost the slides.
Okay, sorry about that. Okay.
And it's back.
Okay, I think we're ready. Sorry about that. Okay, so we've been around for the past 25 years, and the purpose of starting Prescient Investment Management then was to create certainty, financial certainty for clients in this uncertain world. Today, we are 100% subsidiary of Prescient Holdings. The key shareholders within Prescient Holdings is the staff. We recently did a sizable deal to increase our stake to 25%. Prescient Foundation, where we do our CSI initiatives, is also a shareholder, and that's part of our sustainability story. And then we partner with Thabo Dlotty, who leads the Setega consortium and is well known to the Stanlib Group. Within our business, we've got about 60 staff members. We've capacitated a number of teams during the past 5 years, and we are 53% led by the investment team. So in a business like ours, it's very important that we have complete alignment and that the investment team have a say in what we do. So that's very important to be investment led. From an AUM perspective, we've seen decent growth in the last few years as well. Last year being an exceptional year, and today we stand at 130 billion assets under management, but we remain humble. We know markets are quite fluid right now. Our business is split more or less 50% retail, 50% institutional generally. At the moment, institutional is more or less 60% of our business, but that is kind of subject to change. Then from a sustainability perspective, I think it's very much part of our DNA, and I think an inclusive and equitable investment industry better serves our diverse society. So one has to move beyond the tick box. And while we are level BE, level 1 from a BE perspective, we very much subscribe to the principles of responsible investing and sustainable development goals. And then we do a lot of work in the community through Prescient Foundation. From a capability perspective, we've got interest bearing, where most people know us for being an interest bearing house, but we have worked quite hard on our multi-asset equity and global initiatives in the last few years, and have had lots of success in the multi-asset space, as well as in the infrastructure space and in the credit space. So just a little bit of why Prescient. So I think what's different so Prescient's always been a systematic investment house, but what's different to when we started the business 25 years ago is the prevalence of data and information. And if you want an edge today, you need to be able to utilize that data. So we know that because our process is systematic and risk-focused, there are 3 elements that are important to that. So being rational, rules and evidence-based and data-driven is what we lead with. I think within investments, fear and greed is probably the biggest bias that we face, and we know that we can't make decisions based on that. So for us, it's very important that we look at the data and follow the evidence. And if we do that, then really you get to unbiased decisions and clear strategies and processes, and you're able to attribute why and what, and answer the hard questions when times are not great. And also you have a clear path to your investment returns, which gives you peace of mind. And that, of course, leads to consistent long-term outperformance. Consistency, I think, is probably a word very overused in the investment industry. Everybody is consistent, but the way that we measure that is quite clear. So in our flagship fund Income Provider, it's been around for 18 years and comfortably beating its benchmark of CPI plus 3 over the long term. For us, that is consistency. So just to conclude from my side, just a little bit of just a background, I guess, of the team and how we use data within our process. So data is also a loose word, and we'll talk about that a bit later, but Prescient uses or utilizes 120 million data points every day in our investment process. And why does that matter? It means that we are able to do up-to-date nowcasting on what's happening and get a sense of the pulse of the economy. And those insights doesn't matter if you don't have the people to actually analyze that. So we've got a strong team of people with decent experience across all disciplines in the business. So yes, we are very excited about the future prospects of our business. We see ourselves as the future of investment management, and we're really happy to be a partner to your business. Thank you.
Thanks, Julie. And Prescient has been a wonderful partner to our business over the years. And you mentioned Income Provider, which is quite an important component of our flexible income solution. So thank you then. We'll chat a little bit later. Next, I'd like to introduce Derek Msibi, the CEO of Stanlib Asset Management. As one of South Africa's iconic asset management companies, Derek has a deep commitment to ensuring Stanlib makes a positive contribution to society's developmental goals while helping investors protect and grow their financial futures and dreams. Since his appointment as Stanlib Asset Management's Chief Executive Officer in 2017, Derek has spearheaded a new direction for the business, focusing on implementing technology to improve investment and back office efficiencies, forging links with international partners to extend the group's offering to its clients, and rationalizing the suite of funds to appeal to a changing market. Under his leadership, Derek is aiming to become, is hoping Stanlib becomes the most progressive asset manager. This is setting the scene for long-term growth. Just some personal attributes or facts about Derek. Derek is an avid road runner who has completed 20 Comrades marathons, 19 Two Oceans ultra marathons, and over 40 standard marathons. He owns a substantial jazz music collection, enjoys reading financial, religious, and leadership literature. He's an Orlando Pirates and Arsenal Football Club fan, and values the time he spends with his wife and 4 children. Welcome, Derek. And just by the way, Derek is also the longest serving CEO of Stanlib Asset Management. Well done, and thanks, Derek.
Thank you, Lee. Good morning to all the participants in this webinar. Thanks for the invitation, Lee and company, and thanks for enabling me to participate together with the esteemed other CEOs of other asset managers, being Brad and Sherry. I suppose the starting point for me is actually Stanlib is an interesting business in that it is really a function of a merger of 2 asset managers in 2002, which was Liberty Asset Management and Standard Bank Asset Management. It was a recognition that those businesses on their own were subscale. We needed to combine our resources. We needed to prune our offering so that we can become relevant in the market that was evolving. And I think that's played out relatively well for us. It has not been easy. Certainly merging 2 asset management firms is not the easiest endeavor. But I would say that the history has proven that it was the right decision. Over the last 21 years that we've been in existence, our assets under management through various strategies have grown to be where they are today, where for the single manager, we're sitting at about 540 billion rand. The split of that 540 billion rand, there's about 40% of that is in internal money, which is money that we manage on behalf of sister companies, and the other 60% is third-party clients, including independent financial advisors. We are a very intermediated business. 95% of our assets come from clients who have got some form of advisor involved in them. So even though what we classify as retail, those customers are actually being intermediated. In other words, they're working with the financial advisor. So we are very much invested in the success of financial advisors and intermediaries, and we want to make their lives as easy as possible in terms of dealing with us. Over the last 21 years, we've broadened our capabilities. We are very much a full-service house, if I can call it that. In other words, almost every investment strategy that you can think of, whether it's in the private markets or public markets, we offer it. Over the last 4 years, we've worked at consolidating our various capabilities, and at the same time investing in what we consider to be the future of investment management. We've consolidated our equities into one franchise under a multi-style approach. So we're more style agnostic. We're not value, we're not growth, we're not quality. We just harvest all factors and we blend them together to give a more reliable and stable return profile for our customers. We consolidated our multi-asset proposition into multi-strategy. Again, Lee made the comment that we have a desire to be seen as a progressive asset manager. We certainly believe that asset management is evolving, and therefore the way that multi-asset has been done historically is up for challenge and for an evolution, and we want to be part of that evolution, which is why we've decided to consolidate our multi-asset team under a multi-strategy approach, which gives us a lot more levers, a lot more options in how we can actually generate returns for our customers, but at a lower risk than what we would normally do in a typical balance fund. The jury is out on that, but being progressive, we're not afraid of going where others have not been willing to go. The other part of our business that we've been growing is really the private markets and the impact side of our business. I know for a lot of independent financial advisors, issues like illiquid strategies and private debt are not something that is that they spend a lot of time on, but we believe that those strategies are a lot more relevant in the environment that we're going into. And also believe those are big asset classes, which particularly in the South African environment are developing a secular trend, which means that they need to find a position in their strategic asset allocation that is used to construct portfolios. The final comment I would make is we are very aware that the environment that we're in is changing, and therefore investment in technology and partners is important. We think there are two very important trends that are hitting us and are hitting us very fast. One is the relaxation of exchange controls in terms of 45% going offshore. And therefore our customers and our advisors will be looking at what is the best solution to run that 45%. I'm not sure if they'll get to 45%, but certainly in their 40s is where it seems like they will land. That's a big chunk of money that needs to be looked after offshore. And as a result of that, we decided the best way to approach that is to enter into a partnership with a credible, values-aligned, globally competitive institutional asset manager, which is JP Morgan Asset Management. We think the breadth of capability that they offer, the quality of that house, together with the fact that they can actually enable us to be a better asset manager. In other words, not just managing money on behalf of our customers, but more importantly, really infusing best practice and really challenging us on how we can be better in how we run asset management. So that's us, Lee. Thank you.
Thanks so much, Derek. And let's get stuck into the topic of the day. So I'd like to invite our guests all to participate. So we're going to talk about the business of asset management and its impact on the value propositions of financial advisors. So we often forget that asset management is more than just about portfolio managers, investment teams, CIOs, and performance, because behind every asset manager, as you've seen now, is a successful business guided by a clear vision, a well thought through strategy, and an experienced CEO, MD, who along with the management teams are responsible for the execution, delivery, and business objectives. So what we're going to do now is chat to three leaders of very successful asset management businesses who've just introduced themselves. We'll unpack the major challenges and opportunities that lay on the horizon and how these businesses plan to deal with them. So we will delve into the impact and importance of asset managers on the value proposition of financial advisors and the role of the financial advisors, and hopefully we get some key takeaways from our team here on how to future-proof your business. So Cherie, let's start with you, right? So looking back over the last 5 years, in your mind and sort of in that last 5 years, we include the COVID period. What is the biggest challenges in your mind that asset managers have faced, and how's the industry and particularly Prescient dealt with those challenges?
Yes, thanks, Lee. Yes, so life before COVID it's a distant memory, and COVID certainly was a catalyzing event for many of us, and many of us had to re-look at our business. And since COVID, there's been a lot of change we've had to deal with as well, kind of unexpected change, navigating uncertainty. So there's three major challenges I think that we faced as an industry and that affected us directly as a business. So poor or anemic returns in the steepest hiking cycle on record was a tough one to sit through. And how do you respond to that? Well, you have to trust and believe in your process. You need to kind of focus on risk management, asset allocation, and hope that it pays off. And in Prescient's case, it has paid off, and just through the support and partnership with clients as well, because we have a process that's well understood. I think the prospects for the future and how things look today is much better than what it was a few months ago, so that's great. The second big challenge, I think, is on the change in regulation to go offshore with 45%. That also wasn't really well debated within the industry. It was kind of parked on us. But I think we have to assume that we're going to go 100% offshore. I mean, anything can happen. So I think for asset management businesses to consider how all of us are positioned within that, because whereas before equities really was say a passive equity ETF was a consideration to go offshore given the limits that we had. Now other asset classes are going to come into play, and all of us from a local perspective are now in a sea of competition. We have to stand up against global fund managers. So how you respond to that is quite important. So Prescient has a systematic approach to investing, and our process that we employ in South Africa is also portable and can be done anywhere in the world. In fact, performs better globally because of the depth and breadth of markets. And we've also been managing money globally for many years. We are not stock pickers, so we don't have to employ reams of people and analysts to do the work. But it's going to be hard to convince the South African market that local managers have those skills. So that is a challenge. And then the third challenge, I think, lies on the talent side. So COVID definitely catalyzed big changes there. And there are two issues that we faced and continue to face today. That is on the talent side, to attract people to the asset management industry. In our business, we look for very specific skills on the maths, stats, CAs, actuary side, and the willingness of people to go and do PhDs and kind of masters, that's waned because of the economic conditions we face. So we've looked outside of the industry, and we rather say we've taken someone like from IBM who has data skills, and we put her through CFA, and that's a way of kind of attracting people into the industry. And then I think the second thing just on talent, and the last thing is around where we work and how we work. A lot has been said about it, but I think when you manage people's savings, you have to be all in. And so you can't have two buses going in different directions. Everybody has to be on the same bus, know exactly where you are going. So we went back to basics and said, well, we believe that the people that we hire are great. They want autonomy, mastery, and purpose. And if we believe that, then we actually have high levels of accountability and autonomy. So let's just open things up. And we have flexible leave. We tell people you can work where you want. But at the same time, we believe that people are here to build a career with us, and that they want to be part of the growth story. They understand our purpose and our ambitions. So we try to make the office a great place to be, and from that perspective, it's working quite well. But the jury's out. Who knows what lies ahead for us tomorrow?
Thanks, Cherie. That look fascinating insights in, and we'll touch on one of it that you mentioned there, and that's sort of the let's call it the war for talent out there. So it's tough to find really good people to become part of your business. So Derek, Cherie looked at sort of the last 5 years. From your perspective, looking forward, in your mind, what are the biggest opportunities and or challenges facing the asset management industry in the next few years, let's say 5 to 10 years, and how's Stanley preparing to deal with these?
Yeah, look, I think all of us are a lot more familiar with the challenges because they get amplified in various channels on a regular basis, whether it's geopolitical wars, whether it is a rise in inflation, the higher cost of living, etc. I think those have been articulated in a great deal of detail. I'm more interested in really what is the opportunity for all of us who are sitting around this webinar. And in my view, the opportunity lies in the following areas. The first one is that governments around the world are not going to be able to continue to offer a social safety net for people. And therefore, your average individual needs to come up with a way of how they're going to be saved for that. And that is an opportunity for us to be part of that journey in enabling them to have a degree of financial freedom by offering professional services and how we look after their money. So that's the first part. And unfortunately, in South Africa, in the short term, we will take some pain. But the long-term trend is we've got a young population that needs to look after itself in one way or another. Which really builds into my second opportunity, which is that as people get wealthier, they need money to be looked after. They've got an opportunity to save more, and that's where we become relevant to them. We've got to be working at identifying them at an early stage and partnering them through the various cycles of their lives in order to be part of their journey to whatever financial goal that they have. The third one is the amount of global flow that is in the global financial system is huge. We've got to figure out a way of how much of that actually has to come to us in South Africa to look after, to be invested here. Brad made a point that, in his business, they've got a number of sovereign wealth fund managers, sovereign wealth funds who have given money to them. We need to get a lot more of those to actually see South Africa as a good destination for that. So in order to be able to respond to that, it means that you've got to be top quality fund managers. The standards that we measure ourselves and what we aim for has to be globally competitive, because that's what we're competing with. You can either put your money in South Africa, you can put it in London or New York or wherever. The second part is the range of offerings that we need to have, which is why, the way we run Stanlib is that we've tried to be as diverse as possible without actually compromising on the level of depth that is required and scale that is required. And obviously, we've got to really be focused on managing money and serving our customers. Those are really the opportunities that I see. I think the problems are there are many, but if you get obsessed with worrying about the problems, you never see the opportunity that is in front of you.
Love that. I love that. Don't absolutely. The problems are clear, but focus on the opportunities. Thanks for that, Derek. Brad. Okay, so consolidation in the asset management industry. It's become quite a topic, with many commentators saying that up to a third of global asset managers will be consolidated in the next few years. We've seen consolidation happening in South Africa, with a few quite notable businesses actually combining their businesses. What is your view on this, and how is Fairtree positioned for this in the future?
Thanks, Lee. So obviously, where there are merits for consolidation or mergers, I think it's worthwhile to pursue. I am challenged by this thought. When you asked me the question, I thought about this quote from an Austrian philosopher, a guy called Karl Popper, and he basically says that if your theory appears to be the only solution, then either you haven't fully understood your theory or you haven't fully understood the problem you're trying to solve. And so you need to almost question what problem are you trying to solve through consolidation and mergers. And I suppose in my experience, I've gone through various mergers in my life. BOE Asset Management no longer exists. There was a merger between BOE Asset Management and Old Mutual, and it was a takeover. It wasn't a merger. And so mergers don't really exist. They're mostly takeovers. But you don't consolidate or merge your way to success. If you have a weak business, you need to address the weaknesses in your business in order to attain success. So just getting scale through a merger doesn't automatically make you a successful business. And so you need to question, I suppose, the motive behind what you're trying to achieve. Now, there are opportunities to consolidate or merge or acquire, which creates synergy within your business, unlocks certain opportunities, and those have merits to pursue. Within Fairtree, we have constantly looked at how we can serve this purpose of benefiting all our stakeholders. And so when we looked at opportunities which came across our path over the last number of years, it was always about how does this benefit all stakeholders, not just shareholders. And all stakeholders include staff. So merging two people-orientated businesses, or two people-based businesses, is a difficult thing to do. How do you get cultures to blend? How do you determine who makes the call when you walk in on a Monday morning? And so looking after the interests of all stakeholders, I think, is something that is vitally important when you consider consolidation. At the end of the day, merging your way to success is not a strategy. And so I think our approach has been very cautious, very circumspect, almost looking at what could go wrong through merger or acquisitions. Just trying to organically build and grow the business. I think the most important thing in our minds is that pursuing scale or growth at all costs is not something that's been foremost in our minds.
Fantastic. Thanks, Brad. I think you said once, which I don't think I'll forget, a poor business plus another poor business doesn't make a good business. It makes one large poor business. So absolutely lots to think about there. And then, okay, next, Derek. In terms of, so we know that exchange controls have relaxed. The the requirement for a really good offshore, or sorry, Bradley, you reminded me that global is a better word than offshore. A global capability is important, right, for South African asset management. Derek Standard partnered and looked quite widely, as I understand, for a global partner, and partnered with JP Morgan. Explain why, from your perspective, a partnership model is the way you've elected to go, as opposed to building your own global capability.
Yeah, look, I think first of all, it was informed by what we understood the market to need. So we had a piece of research that we commissioned to get an understanding, particularly of intermediaries, around how they see global fund managers vis-a-vis local managers. And the overwhelming data point that came back to us was there are probably 1 or 2 managers in South Africa who have got a respectable global halo, but they run very specific asset classes. Over time, advisors were saying we will need to have a broad range of asset classes, and we don't think local managers will measure up. So that was the reality of the market that feedback that we actually got. And so our view was, well, the opportunity to gather some of the flow that's going offshore is now. What is then is the alternative, because quite clearly as Stanlib, we do not have the halo that says that we can be competitive on actually running global money. And therefore, the quickest way we could look at that was to find a partner, and we're quite rigorous in how we chose the partner. So we said, 1, we need to find someone who's got a degree of alignment in terms of the values of how they see themselves. That was the first one. The second one was we needed someone with global credibility. As much as JP Morgan is owned by JP Morgan Bank, we looked at someone who had credibility with third-party allocators as a second part. And the third part was, and that's something that is missing in a number of the other discussions, is that we believe that we need to get better at being an asset manager and running the business of asset management. And therefore, we needed to find someone who could not only offer us good portfolio management, but also work with us in actually how do we lift our game to be competitive. Because our view is that with exchange control being relaxed, you are likely going to see global managers starting to market their services in South Africa. And as a result, you're not going to be measured by the standard of the local asset manager. You'll be measured by the standard of what the global guys are doing. And that is a unique perspective that we as Stanlib opted for. Also, I think from a capability and a competence point of view, we were faced with a very tough decision about, do you take your team that's running South Africa, which is usually your A team, and send them offshore? Because if you don't send your A team offshore, you're going to get killed. Because you're competing with some of the best people in the world. And our view was, we've got so much stuff happening in our local business that requires focused attention from the leadership team. And therefore, we need to find someone who's already got an A team that can go to war on our behalf. And again, Lee, I need to emphasize, we're not saying this is a solution for everybody. We're just saying for us as Stanlib and what we're solving for, and the way that we defined our problem and our opportunity, this was the best option that was available to us. I think other players might come up to a different conclusion.
Absolutely. I mean, and the facts that they have, and I mean, look, the truth is that you're 100% right. I mean, the competition for South African asset managers with an influx of global asset management into SA is big. So thanks for sharing those insights, Derek. Cherie, a conversation nowadays, you can't have one without speaking about technology and AI and automation and machine learning. So that has become almost a standard focus for businesses, not only asset management business, but how to integrate technology to improve, I suppose, the outcomes for clients and investors. Maybe just some insights around, Prescient's view on technology and how it's used it to improve or meet the changing needs, I suppose, of investors.
Yes, you can't have a conversation these days without talking about AI. And to be honest, the fact that we're talking about regulation and privacy and risks already means that that margin of advantage is going to close. You know, normally regulation closes the gap with the arbitrage that you have to operate in. So it will be interesting to see whether this is just a buzzword and whether people are really able to integrate it and use it in their process. So I think at present we take a very different view to technology. We recognize, and I've got the battle scars for it, that if you go and partner with an external tech service provider, it can be a rabbit hole. Often global partners don't really understand from a technology perspective how to value our instruments, and you really struggle to get what you need. You get a black box and you need to populate it, and it actually takes people out of business as usual for quite a long time. So 5 years ago, when we were struggling with quite a few issues within our business, we decided that we were going to own this process. And how do you own it? Well, it actually starts with your skill set. So we went through the process of reskilling our entire investment team, employing a range of people like data scientists. Today, more than 80% of our investment team can code. So I spoke about 120 million data points that we ingest every day into our process. So to have the ability to do that and to analyze it and make sense of it is pretty important for us. And I think that, again, is kind of where the future of investing is going to go. You need to be able to do really cool stuff, I think, as well with this. Otherwise, it's just meaningful to say that you use AI. How, what, when, where, how does it add value? You still want to create better returns for clients. So the way that we use it, just as one example, we have our own credit cycle indicator where we throw everything into the jar. Websites that we scrape, we can scrape the websites to see the Fed speech, and we can actually then come up with trends to nowcast. We don't have to wait for 2 or 3 months to get a GDP print. The last GDP prints are now casting is actually quite accurate on what it's going to be. Other stuff you can do is to look at what people are searching for. Are they searching for unemployment benefits? What does that say? And you can kind of use data to put trends together. So there's a lot that you can do, but the margin of your advantage is closing quite fast. And of course, I'm just talking about the investment side. There's the other side, which is also the running the business and being more efficient and being able to give clients on-demand reporting, on-demand valuations, proper look-through. All of that is kind of an imperative for us in terms of where the world is going.
Fantastic. I mean, I think one of the cool insights that I've heard you speak about is on that data scraping technology is understanding sort of like the real inflation by scraping the prices of Checkers and ShopRite pamphlets and like, which is quite cool. Brad, so I mean, business models and innovation of business models and making sure that your business model is fit for purpose is really important for a successful business. And I mean, so I was first introduced to Fairtree's business model in about 2012, 2013, if I recall correctly, which is many years ago. And I've always found, you know, the model quite interesting, and maybe you can share some thoughts on it. And I know it's not a platform, right, where you have different asset management businesses, but you know, in some way, Fairtree has created an environment for specialization of certain managers of their asset management teams in certain asset classes, and sort of taken away not the mundane, but you know, things like admin and compliance, etc., away from the guys so they can focus on what they do best. You know, where did that thinking come from, and why has it worked?
Yeah, so I guess you know, if you look across the business, a number of the senior people have had many years of experience in larger asset management businesses, and what we all got to at some point in time. We were talking about my own personal journey. I got to a point where I got frustrated with the bureaucracy that persists in some of these businesses, where you get drawn into things outside of your key focus area, which for investment businesses and investment teams, that's the markets, right? So you get drawn away from that, and you find that your time gets sucked up into that. And so what we've tried to do in building our business is to say, not build a platform business. I know looking at it from the outside, sometimes we had pains to try to express to people that, you know, this is not our intent. But what we've tried to do is we've tried to make sure that people are focusing on the areas where they have the most skill and where they have the most passion. And we remove all the other mundane stuff from them. So in the early years, Cobus and Andre, who were the founders of the business, spoke about putting people in the pocket. And it's a rugby term. It's one that I'm not familiar with because I played football. But basically, it's about the fly off, creating the opportunity for be it the center or whatever the case may be, to put that person in the best position they could be, to use the skills that they have to advance the team. And so when we looked at kind of building this business, we said, well, how can we create an environment where we have people that are focused on being the best versions of themselves, executing on their core skill set and not being distracted by a range of other things. So that's kind of the genesis of it. That's how we thought about building the business. But then the next challenge to doing that is around culture. It's around, do you create this culture where you have first and second class citizens in the business? And so we've worked very hard to ensure that we focus on what we refer to as the kind of triangle of trust. Okay, and how do you build trust within an organization and in an organization is through focusing people on kind of those three areas of the triangle. And the first is that people can come in and be their authentic selves. So I come into the office every day and I have weaknesses. I have strengths which I bring with me, but I'm very clear and articulate about what my weaknesses are. Excuse me. And so if we are able to do that, we're able to augment those weaknesses. So, if you have a really good investment professional who is really good at thinking at a macro level and combining macro and top down and bottom up issues, but maybe doesn't think about the execution pipeline. We don't want them to get into thinking about the execution pipeline. We'll augment that skill set. So be your authentic self, and without any fear or judgment, come into the office and say, these are my blind spots, these are my weaknesses, these are the areas that I'm not good at, and then how can we build team around that? The second thing is then to have empathy, and which is that everybody in the organization says, I believe that you care about me, you care about the challenges I face, and you care about the problems that I face. So if I'm sitting on the execution desk and I'm trading in the market, and there's an issue which arises in operations, there's an empathy to try to help solve that issue and to work together to a solution. And then the third element of this trust triangle is essentially competency, or we refer to it as logic. So essentially saying that, I know you can do it. I know that your thought processes are sound, and I know that you have the competency to solve this problem. So I'm not going to step in and try to solve the problem on your behalf. And so that's kind of at the core of the culture of what we try to establish, and then link those to all of our values. But at the end of the day, what we're saying is we'll create an environment where people can be in the pocket, be the best version of themselves, bring to the organization their core skills, and will augment their weaknesses with other people. I once heard somebody say, and it's a bit of over the exaggeration, but I once heard somebody say that if you only work on your weaknesses, you'll only ever be average. But if you work on your strengths, you differentiate yourself. And so to a certain extent, that's a bit of an overstatement, but to a certain extent, that's what we've tried to achieve through the business model.
Love that, being your authentic self. I like that. Derek, let's just focus on the importance of financial advisors, and especially for a business like Stanlib. We've got so many financial advisors on the call who are our partners. We believe financial advisors are our partners. And from an asset management perspective, from a Stanlib perspective, maybe from your view, maybe unpack the importance of of the advice industry to your business, as well as what is the value add that you as a business tries to sort of deliver to financial advisors to improve their value proposition to the client.
Yeah, look, I think it's a pity that the value of advice in the South African context has been diluted and has not been amplified to the level that it should, because all the research I have seen indicates that those who have competent advisors ended up with much better financial outcomes over the long term. So there's quite clearly a very defined role and value that our financial advisors add. At times, I think financial advisors are not clear about what really is their product. Because, for us as fund managers, we know what our product is the funds. But I think financial advisors are very shy to really punt to the value of what the product is, which is advice. Our ultimate aim as an investment manager is to make the advisor look good in front of the client, of the customer. To me, that is the ultimate test, which is when the customer talks to the financial advisor, have we enhanced the credibility of that trusted advisor? Because as a fund manager, we are not the trusted advisor. We are a product provider. The trusted advisor is the financial advisor who has got the plan, who understands the needs, and who's working at how does he solve for the needs of that particular customer. So we really want to make sure that if they include us or they work with us, at the end, the customer will say, wow, actually, you've added value into the journey that I'm on. So I think that's the underlying philosophy and principle we want to adopt. So what do we really like to see? And our view is that, one, we really want to make the advisor's life easy. We want to be sure that from a reporting point of view, they get the information that they need timelessly and accurately. The second one is to be sure that everybody understands our proposition around under what circumstances do we do well, under what circumstances don't we do well. And then finally, that the advisor is kept up to speed with what's happening in our world. In other words, what's our view of investment markets, what's really happening in our business, so that when he or she talks to the customer has first-hand information from the advisor rather than what they are hearing or what they are reading from the media. We are absolutely convinced that the success of our business is very much linked to the success of the advice that the end customers are actually getting. As I said, 95% of our business comes from people who have got some form of intermediary involved.
Fantastic. Thanks, Derek. Whether it is asset management, DFM, whatever the case may be, the value advisors is crucial. We do not sit in front of the client. We do not deal with the client needs, and empowering financial advisors. I think across the board, we all have our role and responsibilities towards financial advisors. Bradley and Cherie, I'm going to ask you, there are sort of these new kids on the block, right? So DFMs or discretionary fund managers have come along, and the aim of it, especially I suppose the better DFMs, is to come out there and partner with financial advisors to reduce risk in the practice, increase better outcomes for financial for clients at the end of the day. But from an asset management point of view, how do you see a DFM? I think, and I'd like all of you maybe to comment on that, just from your view. What is the role of the DFM? How do you see the DFM, and what role do DFMs have to play in this sort of value chain?
Okay, I'll have a go at it first, if that's okay. So from our perspective, it's definitely a partner, not a competitor. So DFM can take the client on an educational journey, has the time, understands both sides of the needs. I think more importantly, from our perspective, a DFM can understand our strengths and weaknesses, knows how to position our product within different brokerages, can come up with bespoke solutions, can negotiate on behalf of clients. And it really does, systematize the relationship in a way that makes it more efficient and effective and works for both sides.
Thank you.
If I can comment, I would completely agree. I often talk within the organization about intimacy with clients, and that intimacy is really just to understand clients' needs. So our approach as a business has always been a partnership-led approach, partnership-driven approach, as opposed to a sales-driven approach. We don't see ourselves as selling a range of products to end investors. We see it as trying to match solutions to those investors' needs. And the reality is that we, as an investment management business, if I talk about being our true authentic selves, we don't understand all the challenges that individual investors face. We don't understand all the challenges that advisors face, let's be honest. And I think what DFMs have done is stepped into the gap and stepped into the breach to try to bridge that partnership relationship and bring that intimacy to the partnership by understanding both, from a practice management point of view, from an investment point of view, all the elements where DFMs can actually add value to advisors and bridge the gap to ourselves as investment managers. So to our minds, DFMs are vitally important in the development of the market. And we've seen it in other markets as well. We've seen how DFMs have established themselves as key partners here in the UK, and across other markets as well, in the US as outsourced CIO type models, etc.
Yeah, cool. Thanks, Brad. Derek?
Yeah. Look, I mean, I think there's no doubt. Again, I tried to do quite a couple of pieces of research on the market, how it's evolving. I mean, the data that we have shows that the vast majority of financial advisors indicates that they will likely going to increase the use of DFMs. So that is a trend that is not a sort of a temporary trend. To me, it's structural around how this market is going to work going forward. And an increasing proportion of assets will go through some form of DFM involvement, which shows that there's quite clearly value that the DFMs are adding, both to the asset manager by being a lot more professional in how they choose managers, introducing a lot of rigor, and also making sure that decisions around who gets fired and who gets appointed are not made on a whim. So I think it's going to be good for all parties. However, the elephant in the room is who's going to pay for this? Because the end client is not going to pay more than what they are paying at the moment. And so that's where the relationship between asset managers and DFMs is going to get quite interesting, because my view is that the only portion that can fund the DFM share is the asset management fee. And therefore, I think there's going to be contestation on how that pie gets divided over time. And that's why I sort of at times make a tongue-in-cheek comment that DFMs are a frenemy, as Winston Churchill would say. There's a great deal of positive, but the economics of it, need to be paid for. I also got one more comment on just DFMs, which is, I think as fund managers in general have got a greater degree of transparency on performance, transparency on fees, and there is almost like an objective measure of how well they are doing or how badly they are doing. I think the DFM market, there's all kinds of smoke and mirrors going on there, guys. And, I sort of at times scratch my head and think, oof, you know what, I wish someone could shine some light on what's going on there. I can see that, for instance, that you guys this morning, you show your performance, et cetera, and it's possible that you are an anomaly. But I think there's a lot of stuff that still needs to come out into the open so that we can have a very good assessment of who's doing well and who isn't doing well.
100%. Look at the comparisons between DFMs or performance is crucial. And I think there's a lot of work being started in that space, particularly with things like the Citywire Awards, where you actually have to submit your performance and they compare and contrast. So look, I think transparency is growing. We've been a proponent of pushing transparency, performance reporting, etc. And it definitely I think the journey is starting, but everybody needs to jump in. So if you're not using a DFM that publishes the performance on their website, guys, you should ask yourselves the question why, right? So thanks, guys. Thank you so much for your participation. We had so many comments, particularly from Frank Agliotti. He loved a lot of what you guys have to say. So have a look at some of the comments. Thanks, Frank, for taking the time for putting comments out there. I know there's one or two questions we weren't able to answer. We have run out of time. Rico will join us now to discuss the hybrid approach. So guys, please stay on until the end. We just got sort of 10, 12 minutes left. And then we will close off. Thanks, everyone.
Thanks
so much.
Thanks, Lee.
Excellent. Thanks, Lee. So very informative session. Thank you, Lee, from the CEOs. And what I'll do is just briefly go through the hybrid approach. We've had quite a few interactions with our clients, and at our annual seminar, we took clients through the construct. But I just wanted to run through it briefly and maybe touch on one or 2 points, especially questions we received from our clients on the construct. Now, the construct change that we applied on the INN8 portfolios was primarily driven by the change to Regulation 28 with a higher offshore percentage at 45%. And we heard the CEO speak a lot about how that will change the business and the threat of DFMs and clients using direct offshore managers. Now, our solution to the approach is a hybrid approach to investing, and I'm going to take you through details of this hybrid approach as we go through it. But maybe just to take a step back first, I'm sure by now you would be fairly familiar with the construct that we've used, or the range of funds. Flexible income fund, the most model, the most conservative, all the way to the flexible growth model, the most aggressive model, with the various objectives. Now, those objectives and portfolio construction techniques we apply is driven by our optimization modeling. We spend a lot of time on this modeling, collect 123 years of data. We use forward-looking assumptions, and there's a lot of research happening in the team in what we call our strategic asset allocation committee, or through the committee, in formulating these objectives, and then subsequently how to construct the solutions to meet the long-term objectives. So I just wanted to make that point. And when we look at these outcomes from the models, it does suggest you need a sizable global exposure in your solutions. You need to have more global exposure in your solutions as you move up the risk versus return profile. So from left to right in this chart, as you move to higher risk or real return objectives. And at the bottom is gross of any fees. That's why some of the numbers might look high at a real return of 7%, which puts us back at about 5.5% after fees on a typical balanced fund. And that just points to us that we need at least 30% on average, probably 35% global in a typical balanced fund. Now, that's just to point to the fact that we think global is becoming more and more important, but we don't necessarily propose sitting at 45% at all the time. That's because liabilities for our clients, we have to assume, will primarily still be in South Africa. So we're managing a rand-based solution. We diversify through offshore, but at the end of the day, our assumption is that most of our clients will use their money in South Africa. The expenses will primarily be in South Africa, and they'll continue living in South Africa. We think it's flexible to be within the allowable within the allowable limit. So we'd say most of the time the typical high equity model would be in the range of 30 to 40% offshore. That doesn't mean we and the underlying managers won't drift below 30 if SA assets offer great value, and it doesn't mean we won't be at 45 at times, but we think most of the time the range of 30 to 40 is great, and more conservative portfolios a bit less. But we think the key thing is to extract the maximum alpha from the offshore exposure in the solution. So that means if we having the optimal offshore, but not just that, also getting the most return from those offshore managers that we use. Now, I wanted to use an example that I've used in the past to explain the hybrid approach. Now, imagine a world where DStv gave you the option of only selecting certain DStv packages. Now, the first one most of us would probably grab is the sport channel. It's the one channel you struggle to get on its own. But imagine a world where DStv offers you the sport channel only at a very affordable price. And yeah, I mean the main sport channels. Now, imagine you can then buy other packages from DStv, maybe CakeNet, if you and your family enjoys watching CakeNet, or there might be some other local content you enjoy, or HBO is on DStv, many HBO programs as an example. So you buy that. Now imagine you can top that up with a lot of the streaming devices, Netflix content, Disney Plus, if your kids enjoy their cartoons, and children program, and a lot of other content obviously out there across the world. And imagine if you can then package all of this together and it costs you the same as DStv or less. You get much more bang for your buck. You get all the content you need. You've got a lot of different options. And that's exactly what we try to do, or what we have done in the hybrid approach in our DFM solutions. Now, how does that translate back to managers and portfolio construction? Now, we think some managers are good all-round managers on both the local and offshore side. One or two examples: 91 Opportunity, great offshore capability, MNG, good offshore capability, etc. Also good on the local side. Other managers are very good on the local side. Now, that doesn't mean they're not good on the offshore side. Their strength is just on the local side, in our opinion at least. This is most of the time the boutiques, the likes of Lorium that we use, probably a Truffle, someone like ABAX. A lot of these managers we think are exceptionally good on the local side. And then we've got access to the best global managers across the world. So we can supplement local-only strategies with these top, best in the world local managers and funds that we can select from. So our aim is to utilize the best capabilities and strengths from managers available to us. That makes sense in principle. But how does it work in reality? Does it work? Now, it's not a new concept for us. We actually have a very long track record in managing similar mandates. And I'm going to show you some performance numbers later. The other level of diversification we think is very important is size. So we've got these big cruise ships. Again, a Coronation, 91, Allen Gray. Those are steady managers, often a bit slow because they're big. They can't necessarily move as quick. And we've got these speedboats. Again, most often our boutiques. They're in and out of stocks. If they want to, they can be very fast in and out. They can take opportunities very quickly. They can take small opportunities that the big asset managers can't necessarily take because it would just be too small of a percentage in their portfolios. So we think that extra, what we call enhanced diversification, provides a great different element to our portfolio, providing alpha for our solutions and clients in future. Now, to summarize the benefits, we think it's flexibility on both levels that clients get. Diversity in thinking, best in asset class alpha, a reduction in TICs for our clients, or total investment charges. It's a question we get a lot from our clients. Is this more expensive? The perception is that offshore managers are typically more expensive. And yes, they are if you buy funds in isolation. But as a DFM, with scale, we can negotiate very good offshore fees, and our product costs have actually not increased, and in some instances even reduced, given this hybrid approach of investing. And then also access to unique opportunities. So Cherie from Prescient spoke about AI. That's something we're investigating to see how can we over time incorporate themes that some of the managers are potentially not exploring. And that could be AI. It could be any great themes we pick up from our research and our sources in the market. And we think this tips the balance of probability in our favor. This is the proof. Very good performance from our range over time. This is the multi-manager branded range. Excellent performance. This is built on the hybrid approach. So this is the proof for us. And combined with that, excellent performance from our global equity feeder fund. That's a key element for this. You need to have a very good global equity product at a competitive pricing. And happy to chat more to our clients or any of the clients wanting to chat to us about this research we've done, why the hybrid approach is so effective. Now, I'm going to close off with one or two last slides. This is just a list of the managers. There's not enough time to go through all of them, but these are typically the managers we've partnered with in the INN8 Invest DFM construct. And we will pick from these managers when we build portfolios. The list expands over time. At times, one or two managers might drop off, but this is typically, we think, an excellent set of managers that we've formed partnerships with. This is an example on the moderate growth portfolio, how a typical solution looks. At the top, you've got your managers or funds that's local plus global. We have not converted all funds yet. There are a few reasons. One is accessibility in the local market, managers willing to launch SA funds, and that's a negotiation with us. And we've negotiated with the likes of Lorium and various Batelier and various other managers to launch SA funds. We'll probably move more funds to SA only. But at the top, currently, the funds with global and local. The blue block is our only funds we've converted in this model. There are more funds that don't necessarily sit in this model. And then the last line is the global flexible strategy we use. That's all those great managers you saw in the standard multi-manager global fund. One question from our clients, why not just buy these managers directly? And the simplest answer, for efficiency, it's much easier for us to have one line item that we then use, or one fund that we use consistently across all our products. It becomes an administrative nightmare if we had to buy all of these individual ones, treat customers fairly, etc., across various product clients and product ranges. So that's why it just creates a lot of efficiency having it in one CRS that we can then access. But you can see excellent managers you get access to. Many of these managers not necessarily, you won't necessarily be able to access directly, but the likes of Sands, Bailey Gifford, Veritas, a long list of great managers there. So to conclude, a dedicated offshore capability with a team in London, Jersey, working with us in South Africa. Huge amount of research, thousands of hours each year goes into finding the right managers for you as our clients. We've got a solid track record in the hybrid approach and no bias to local managers. We fish in the biggest pond available. We find the best managers for our clients. Excellent. Thanks, Lee. It was great presenting and back over to you. Thank you.
Thanks, Rico, and thanks for everyone who stayed on. We've come to the end of our webinar. It's the 22nd of November 2023. We are at the end of the year. Many of us are going to take some time off. If you are, please be safe and enjoy the festive period with your families. We'll see you in the new year. Thank you for your support this year. It's been phenomenal. And we can't wait to get back into the swing of things early next year. Thanks, everyone. Goodbye.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.